Welcome back to the Think Bigger Real Estate Show. I'm your host, Justin Stoddart. Excited to be with somebody here today that's going to help you to build wealth. Everything in the real estate industry oftentimes talks about how to generate income. Very little of it talks about how to keep income, how to keep higher commissions, how to use that money and leverage that money to truly build wealth. Today, we're going to talk about that. Before I introduce today's guest, let me remind you that inside the Think Bigger Real Estate group on Facebook, we go deep. I'm going to invite Sean to be a part of this group. He'll be available to answer additional questions that you have. And this is where learning goes deeper because you'll be engaged, not just listening. Again, I'm grateful for all the listeners, but again, if you really want to implement these things into your life, build a network, engage in the content, that's where growth happens. Today's guest, his name is Sean Adams. He's based out of New Jersey, serves clients around the country. He's somebody who has been an entrepreneur for a number of years, ran multiple businesses, realized that there were some things that he could have done better and some strategies that he wished he would have adopted. Once he learned them, he realized his life passion was to begin to teach them to other people, really helping business owners and entrepreneurs take their high earnings and be able to turn them into wealth. So Sean, it's a pleasure to have you here on the show today. Thanks for your time, man.
Justin, so great to be here. Thanks for having me.
Yeah, no, of course. Talk to us a little bit, again, just so that, again, we're dealing with very busy professionals. Probably the busiest time in their entire career is right now, right? It's very urgent. So I want to cut right to the meat. I want to cut right to the chase of when you have a high earning professional, what are some of the biggest mistakes that they make with their commissions when it comes to maybe the way that they're structuring themselves from a tax standpoint, from a long-term wealth earning standpoint? What are the mistakes that you see right away that are like, ooh, that's a painful one?
Yeah, Justin, jumping right in here, the biggest mistake I see people make is assuming all advice is created equally. We were talking before the show got recorded about some of the big names and pundits in the financial education space and investment world and just kind of personal finance heroes. And often they have the loudest microphone, meaning that they have a huge audience of hundreds of thousands of people, not naming any names, but there are people that will follow them religiously. And they have a message that is really designed for the 9-to-5er who makes 50 grand a year and is trying to be a better saver, get themselves out of debt. And oftentimes that message gets spread to every single income class, those well below median, as well as those who are your audience, who are really succeeding, making well over six figures, who are having large commission checks. They need to figure out taxes. They need to save in a more efficient manner. Those general principles, that general financial advice is not applicable. And so I always urge people, first thing is to make sure you're getting pointed advice for your type of industry, for what you do and for your demographic, right? If you're making over $100,000 a year or you're well on your way to, it's important to understand that one, the biggest erosion is going to be taxes, right? So having a good way to be able to mitigate that a bit and have a little bit more control. Those are the areas I usually try to start with people when they're thinking about this. When I was a high paid sales professional in the software space, this exact same thing happened to me. And that's what really got me into some of these light bulb moments of realizing that there's wealthy people out there that do many, many different things, like what we're going to talk about here with some of this conventional, looking at privatized banking and how to kind of build our own source of funding. These are things that the wealthy have been doing for well over a century, right? And so just peeling those off and making them applicable for us and not just taking all general advice equally.
Yeah, no, it's great advice. It's interesting, your concept. I don't know if it's your concept, but it's something that you've adopted and you help people to implement, right? Which is this infinite banking concept. So appreciate what you said about taxes. I do believe that if people are not dealing with a high-level tax professional, then you're giving away free money, right? The tax code is built for people who read it and understand it, right? And people who have professionals that can help them to interpret it and apply it to them specifically. And if you don't have that, if you use an H&R Block, you're trying to save some money doing taxes on your own. I would argue it's the same thing as somebody trying to kind of save some money by selling their home on their own, right? We all know that that's not going to turn out in their best interests, right? If you're actually looking to succeed at a high level, then you need to hire a professional, right? Be who you wish your clients would be. So from a tax standpoint, great advice, Sean. Let's get into this concept of kind of infinite banking. I know that real estate agents, again, making great money, have the ability to fund some things, but probably not have the ability to fund everything that they want, including investment properties, right? Constantly across their desk are investment opportunities that I'm sure they would say, man, I'd love to own that property, not just be selling that property, right? So talk to us a little bit about how maybe one can start to be prepared to be their own bank, right? In addition to the traditional lending sources that they're used to, What else is out there? Kind of help us understand what people are missing there.
Yeah, Justin. So let's back up just a quick second. I'll kind of explain what this concept is and why we're focusing on banking. I think this can throw people for a loop often. I had to find this out the hard way, but when we talk about the way the banking system works, 9 times out of 10, people have no idea actually how banks make their money. They understand that they're profitable through fees and maybe some fractional banking where they're lending your money out. But most people don't realize what banks are actually doing with that large capital. They call it tier 1 assets, essentially like the top tier set of capital and how they allocate it. So banks are in the business of making safe, guaranteed returns, right? They can't go risk big portions of capital on anything volatile. It has to be safe and guaranteed. And if you actually look at the balance sheets, it's all public information for the largest banks. I think there's well over, 3,500 at this point in the US. They use this concept called BOLI, which is actually bank-owned life insurance, believe it or not. And so essentially you go and deposit money into your account. The bank then is only liable to keep a very small amount in their reserves. And other than that, they take that cash along with their own capital and lots of other people's capital, and they invest it in these BOLIs, these bank-owned life insurance policies. They do that because the way that the policies are structured, and it's very, very uniquely designed and engineered, it produces a guaranteed rate of return that is not linked or correlated to the stock market. So they get a guaranteed rate of return. The minimum is 4% that they're able to get back. So the bank it's the greatest business model in the world. They get money brought to them. They get to deposit it into an investment. That investment has a guaranteed rate of return of 4%. And all they're liable to give back to you is whatever you guys agree on, which most people is 0.1% or something even less than that in a savings account. And so when you look at wealthy people, when you look back from the time of the Rockefellers and even before that, they recognize there's this weird little triangle going on there, and the bank is the middleman, and they're making all the profits off of us. So the concept is to really say, okay, we've been told our whole lives that banks are safe and that's where we should keep our cash, but not realizing what's actually happening behind the scenes. So what the wealthy people do is they alleviate the bank from the equation, and they actually start these policies for themselves. So they're storing their cash in a warehouse. It's just a better location. It's not about this being the end investment. It's not like 4% is like some crazy return. It's about if your money has to sit somewhere, instead of sitting in a savings account where you're getting next to no growth, we're putting it in a better location, a better home for it to sit in. And inside of that, it functions very much like a flexible savings account where you can actually access and leverage out against the money. There's lots of tax advantages we can get into as well. Many, many more layers of protection compared to a traditional bank account as well. And this is the whole concept of actually using the policy, what actually puts us in control of what happens and how we use the money.
Fascinating concept, right? When you think about just how you described, right? Where you've got banks that are making money. I once had a friend who joked, like, why would you rob a bank? Well, it's because that's where the money's at. Now, I'm not recommending anybody go like rob a bank, but the concept is kind of very much the case is that banks, they make a lot of money, right? It doesn't seem that much when you look at a little bit of fees, but when you look at the way that they can leverage the money that they have and take that money and invest it in other things, that's what I hear you saying. That's exactly what you can do is you can become your own bank. You put money into this, you called it a warehouse, right? We'll talk specifically kind of what that is here in a minute. But inside that container, if you will, that allows you to then take that money and put it into investments that would earn far more than a bank would give you.
Yeah, so we really call it like a triple play or like a multiplication method, right? And so most people go, okay, Sean, I stick my money in my bank account when it gets deposited. I put a little bit in a 401k. I put it in a mutual fund, or I may fund a residential, like a real estate project of some kind, an investment project. Mm-hmm. And the arbitrage that we get, so basically when we put that money in the bank, it's basically an or asset, meaning that it's either in the bank or it's in an investment, right? It's one or the other. With our kind of triple play mindset here is we're putting it into our bank account first, where we're getting it deposited. And then we're putting that money into a policy second, and then we're actually dispersing it into an investment. And we're doing that through leverage. So essentially the insurance company allows us to deposit, and there's kind of ways in which we have to structure that, cash into the policy. The policy, first and foremost, buys us life insurance and coverage, but there's a cash value component which functions just like equity in your house. It's basically just a little savings account there. It has real tangible value, and you can actually take a loan out against that, just like you could do with equity in your home, and you can use that anywhere that you might want. And so the beauty is the 4%, if you do it properly, should be the minimum amount you ever make on your money again. The idea then is you can use this to go put into a flip, to a syndication, to reinvest in your business, whatever that might be, because at the end of the day, rate of return is all that matters. This strategy just helps you amplify that rate of return.
It gives you one more resource, right? One more kind of lending institution, which is yourself, that you're not beholden to a bank's appraisal, et cetera, right? You call the shots on that. And I'm sure there's requirements as far as how much you need to keep in, I would imagine, right? And how much you need to be paying in. But outside of that, it's your money, right? Even though it's serving the different purposes of creating actually a life insurance policy, right? It's also earning a return, like a guaranteed return, plus it gives you the ability to go borrow from it. Is that the three-part? Is that the triple play?
Yeah, the triple play really is what I mean by kind of the velocity or the movement of money, right? So money gets deposited in our bank account first, right? So if we get a commission check from a client or from our office, and that becomes our income, our take-home income, instead of then holding it there until we're ready to invest it in something, we put it into the policy second. So bank to policy to investment. And that triple play allows us to almost like give it little special powers and move that money. So it just gets friends. It begins to grow within that. So yeah, there's lots of advantages there. One of the main ones, if we want to unpack that a little bit, basically we're setting up a flexible savings account, but it's inside of a life insurance wrapper, right? So when I say first and foremost, we're buying life insurance, we all know that we need some sort of life coverage, right? If something were to happen to us tomorrow, our family would want to be covered in case there is, the terrible thing that ends up happening. Right. The issue with something like term is it's just like renting. It's purely an expense, right? So if I'm paying even $50 a month, less than 1% of term policies ever pay out. And while that might be a good thing, right, meaning that you're not having to use that money, that means that less than 1% of people ever die prematurely, right? So it's just a bet. You're betting that you're going to die early, and the insurance company's betting that you're not. And they have the odds very, very much in their favor. So ultimately, you're just kind of paying into an empty expense each and every month, just like you do with car insurance, right? I pay $100 every single month. I get covered if I need it, right? Well, with the way these specially designed and engineered whole life policies are, the cash value life insurance, imagine paying money into your life insurance or your car insurance every single month. And that $100 that you keep paying in, it begins to accumulate if you're not using it, right? So imagine you went 2 years and you never filed a claim, never used it. Yeah. And at the end of the 2 years, the insurance company was like, oh, you have $2,500 in here, or whatever that amount is, because you haven't used it. And they kind of like roll over, they'll allow you access, right? That doesn't happen in any other kind of expense except for this kind of life insurance. And you have access to that cash, almost like a health savings account functions the same way, where you be able to use the equity that you're paying in because you haven't basically triggered any of the death benefit coverage in the insurance. And so the living benefits, the part that we care about while we're living, is that cash accumulation inside the policy. But on the back end, we get all this death benefit coverage. So from a tax perspective, your audience is high paid professionals, right? You guys are really good at what you do. You're making more money now than you ever have in this market. And if you're shoving money into a bank or right into the market, it's often a lot out of your control, right? If you stick it in a 401k, there's limitations, how much you can put in, when you can access it. There's fees and penalties, right? You're not very much in control of what's going on. If Elon's latest text affects the market, all of a sudden you see your income start to drop off, right? So a lot of external factors. And what the wealthy look at, what big corporations look at, is using these policies as a safety net, right? So tax free money that they can access while they're living. And there's a huge death benefit coverage if they happen to die prematurely. But even on the long end, if they die at 105 years old, nice and healthy, that is going to be a tax-free wealth transfer at that point as well. So having that level of protection is really powerful. And if you want, we can cover some of the tax advantages there as well.
Yeah, let's do it. I think that's interesting to people because, again, right now, many real estate agents, not all, but many real estate agents are making more money than what they're used to, right? And they probably, my guess is, don't have a great strategy just because they haven't had time, right? It's been a crazy sprint for the past 12 months to actually sit down and say, what's the best way for me to invest or utilize this money? So I'd love to hear your tax conversation. Please do.
Yeah. So the way that these policies work, it's very much like a Roth IRA or Roth 401k. So you actually have to pay in with after-tax dollars. But once the money gets contributed to the policy, if you do it correctly, it should be tax-free from that point onward. So what ends up happening is the growth, that 4% that we're getting, it's technically tax deferred, right? So if I'm putting in $20,000 a year into a policy and it swells and grows to $500,000 over time, let's say I've only put in $400,000, right? That $100,000 worth of growth, if I were to ever want to withdraw it, then I'm going to be taxed on that growth. But I can withdraw up to my cash basis or cost basis, meaning what I've paid in because I've already paid taxes on that. But if you ever want to access any amount in that cash value, you can do so utilizing something called a policy loan. So again, very similar to equity in your home, right? So instead of what would be the worst thing you can do? If you had $500,000 that was gaining 4% compound interest every year, worst thing you can do is take a withdrawal, right? Take the 500 down to 400. Now 400 is compounding. So what the insurance company says is, look, we'll act as the bank, right? And pretend this is your home equity. We'll give you a loan out against that value. So if you want to take out 50 grand and go put a down payment on an investment property, you want to take out 100 grand and go put it into whatever you might want in your business. You have the ability to take a loan out against that using the cash value as collateral. Now, the reason why you would want to do that, because there is an expense for taking that loan out, is because you actually get to use the money in two spots at once. Because what happens is the insurance company says, okay, we're going to keep this money intact. We'll give you a loan out against that value from our general account, like a bank would do. You get to use that money however you want. If it's for a vacation, an investment, your business, whatever you would want to do. Ideally, you're putting it into an asset like other pieces of real estate that are spitting off a return. And the entire value, so let's say it's 500 grand in that policy, that's going to continue to grow at that 4% rate as if you never took that loan out against it, right? Because you technically didn't withdraw it. You just used it as collateral to actually take a loan out against it, right? So just like your home, just because you took a home equity line of credit doesn't mean your property value doesn't go up every single year, right? Same exact idea. Does that make remote sense?
Yeah, no, that's really interesting. That's a side of this that I hadn't heard about. Really interesting. Let's talk a little bit about some of the myths, right? I've heard some of those famous pundits, right, speak like, why would you ever do anything but term life insurance? Why would you not just take that money that you would pay into like a whole life, like you're saying, and invest it in the market, right? And or save it, or but it's pointed out that the fees are horrendous, right? Here's one rebuttal that I'll give to that argument is that by nature, Americans are not good savers. And maybe it's just like humankind in general. If there's money available, they'll find, like, the wish list is always bigger than the budget in most cases. That as soon as you get to a certain level of income, you've already kind of spent that money in your head, whether it be a kitchen remodel or a boat or a car or a vacation or whatever. You're kind of waiting for the time to get to that point. And unless you have a forced savings account, like your mortgage payment is to some degree, you don't save, right? And you get to the end of your career and you're like, I would really like to be retired right now, but I can't. So I'm going to keep on selling homes because frankly, I have to, right? So just the endless amounts of people that are in that situation is evidence that I'll go ahead and use my own self. I was sharing kind of one of the big, kind of rebuttals, right, to this concept of just do term, which is this concept of people are bad savers, right? And you were then beginning on, okay, like what are some others? Like why would people not do, or what do people say? Or what would be your rebuttal as to why people would not employ a strategy like this? Because it makes great sense.
Yeah, one of the big things that people come to is, oh, Sean, I'm seeing a larger cost here in the first couple of years. And for some reason, people have been brainwashed to believe that that means it's a bad deal. And one of the reasons that's the case is because traditionally how whole life has been sold, in full transparency, is a bad deal. Meaning that since the 1940s and 50s, when they started really packaging this stuff together, whole life was strictly based on the death benefit. So it was a very, very inflated, very expensive premium that you would pay, and it wouldn't break even, meaning there'd be no cash value accumulation until years 15, 18, 20. So you're basically, paying blindly into this hole, and it's not really even giving you any living benefits. It's just kind of inflating this large death benefit, not doing anything for you from an investment standpoint. Unfortunately, that practice still goes on a lot today, and they don't realize, most agents, most carriers don't realize what's possible within the tax code and the insurance code as to where you can shrink down and utilize this tool. And so most people have experienced the very, very expensive whole life and have just decided it's not a good fit. And just like anything else, it's just with working with the wrong professionals, right? Just like someone who goes and works with a brand new realtor who knows nothing about the industry, and they get their butt handed to them, and they get into deals they weren't interested in and neighborhoods they weren't interested in because they weren't working with the right professional, right? It happens all the time, and they don't know the rules to the game. And that's why often this gets pushed as something that's just not a good fit. But that's a blanket statement, and it's something that's certainly not the case. And so when it is structured and designed properly, it can be a very, very powerful tool. And we normally, on average, cut our whole life policies down about 75, 80% of a general whole life policy. So it's much, much more advantageous from a cost perspective. But with that said, it is a long-term strategy. So like we say to everybody, you need life insurance anyway. You could pay like rent into this thing that's just going to evaporate the second that it leaves your hands, or you could pay into a policy. Yes, there's a cost there, but it's going to, one, cover you from a death benefit perspective and give you the insurance coverage. And secondly, it's going to be setting up your long-term future self in a really good position. So our policies usually break even between years 2 and 5, where you're actually seeing full, every dollar I put in shows up in cash value. But for those first couple of years, yes, you might put in 20 grand and you might see 18,000 available in cash value. Mm-hmm. That difference is going to the expense of paying the coverage, right? Just like you would do with term. So it's the same general idea, but people who are just looking for the lowest cost, the lowest discount they can get, yeah, it's not going to be the greatest strategy for you. Mm-hmm. So it's about having that long-term mentality and wanting to have control over how you use your money. If you put your money all in the market, something happens to the market, of course it goes down. But secondly, if you need to use that cash to reinvest in yourself, your education, your business, you're not going to be able to do that. You're going to have to liquidate your position in the market and then go and invest. Where here, that triple play, we're putting money and holding it in that warehouse until we're ready to disperse it.
Mm-hmm. Yeah, it gives you instant access to investable money. You know, I have guests on oftentimes, and we talk about one of the greatest benefits of being on the front lines as a real estate professional is the fact that you've got early access to deals. You have a deep knowledge of the market. And I see many agents who get that concept, but when the time comes, they aren't ready, right? They don't have the funding. Maybe they have a HELOC, maybe they don't. But imagine having multiple places from where they could pull in order to finance themselves, whether it be just the down payment or potentially even the entire property. It gets to be a pretty interesting concept when you can start to set up multiple banks that you own that give you the ability to now fund these investment properties as they come across your desk. Makes great sense, right? For anybody that really wants to build wealth long-term, be positioned to take advantage of those opportunities. I can see how this could be a really wise strategy. So.
Yeah. And Justin, just one more thing on that, just thinking about dry powder, right? We're making more commissions than we've ever experienced, right? As real estate agents. So if you are hesitant to invest in the market, if you're hesitant to buy that investment property, you're not really ready just emotionally or other things going on in your life, where's your dry powder sitting? And if it's sitting in a bank account getting no growth, that means it's actually losing value, right? There's all this talk about inflation. It's because the value of the dollar, the more the time goes on, the less value it has. So if it's not growing, it's not just staying still, it's actually losing value. So when you position it in a better storage mechanism, like one of these policies, it's at least keeping up with that creeping inflation that's happening. And so it's about locking in that. So you're not just sitting there. And again, one more time on the protection side, it is actually a private engagement between you and the carrier. So if you ever go through divorce, bankruptcy, there's a death in the family, any catastrophic event or litigation that happens, most states, if you have your money in different types of brokerage accounts or just a regular bank account, those things are seizable if you ever get sued or anyone comes after you. Don't take this as legal advice, but almost every state, if you have your money in a policy, it's viewed as life insurance first, meaning that litigators cannot come and access that money. It's essentially off the table from that. So if your dry powder is just sitting in a bank account, not growing, not protected, not keeping up with inflation, you're really doing your future self a disservice, because you know that this market isn't going to last. You want to make sure you're maximizing this crazy time and keeping those dollars working for you.
Well, you bring up a really good point, is that, the wealthiest people know when to buy, right? They buy low and they sell high. I don't know that there's anybody that believes that right now, whether it be the stock market or the real estate market, is at a low, right? Will there be a low in the in the future? We don't know, right? But if you're uncomfortable, just like Sean said, I'm really just repeating what he said, but I think it's a point we need to put an explanation point behind, which is if you believe that there are deals to come, whether because there's a whole bunch of foreclosures that would have happened, but have been kind of kicked down the road because of the COVID, governmental benefits that have come about, and or you think that potentially the economy is a little frothy, that there's just some overpricing of some things, and you believe that there's going to be a lower price to pay for some of these things soon. Then, what a great opportunity to, like you said, put your money in something that's protected, that gives you the ability to access it in the future when that timing is right, when the great deal does come in front of you. And in the meantime, like you said, have it protected, have it earning some money on itself, over what the bank would give it. So great stuff, Sean. This has been really insightful. Appreciate you sharing. Thanks for your patience with the intermission. And I want to point everybody that's listening to this. At this point, it'll be people that are listening to this after the fact. I want to point you to a really, really generous offer that Sean has offered. He typically charges for this, but for guests of this show, he's willing to do a wealth audit, which is just simply take a look at where you're at. And Sean, I don't know what else that entails, but that's kind of my thoughts. Do you want to kind of expound upon that and even let us know how they might go about setting that up?
Yeah. So guys, anytime we're talking about people's finances, I never like to push anybody in any direction. It's important that you understand these concepts and you start to have these light bulbs on your own. It's not just, hey, I heard a guy on a podcast, now I'm going to invest my money in this thing. That's not the goal at all. We want to make sure this is something that seems to be a fit for you first. Mm-hmm. So the first place I always tell people to go, if you go to my website, leveraged-life.com, I have all kinds of resources on there, blog posts and videos. I even have something called a video crash course. It's all free. You don't even need your email to access it. I've got like 30 some videos on there, really short, little, simple breakdowns of this concept. It tends to be a good way to warm people up to this, see how you can use it in real estate, how the tax benefits work, how you can leverage it, and it kind of gets you a good idea. And from there, if you think this might be remotely applicable for your scenario and you want to actually explore that further, we normally do sit down and do a 1 hour wealth audit. We'll offer that for free for your listeners. So you can book that right on the website as well. Again, leveraged-life.com. And if you book that call and you come from this show, I want to make sure that Justin gets a shout out as well. So let us know. You'll see there's a box to do that. And by doing that, we'll also ship you 2 free books. So we'll send you our free ebook that we have about this concept. And we also have a book called Becoming Your Own Banker by a gentleman named Nelson Nash, who has since passed away, but he kind of pioneered a lot of these concepts for the general public about 30, 40 years ago. And so it has a good book of kind of going through all that. So we'll share and give that away. Anybody that wants to book one of those audits, and we'll actually get on a call. We'll break down your scenario. We'll plug into our calculators and show you an illustration of how this would work for you.
Great stuff, man. My final question for you is the signature question of this show. Again, this show exists to help people to think bigger, help them to think bigger than real estate, helps them to recognize the potential inside of them, and then to live in pursuit of that. And my question for you is about your own personal growth. What does Sean Adams do to continue to grow himself, to continue to expand his possibilities? What does that look like for you?
Yeah, I would say it's context. And by that, I mean, I'm educating myself. So I'm putting myself into different pieces of content that help warm up and improve my context for how things work. And I'm putting myself into conversations and scenarios with people that are much, much further up the food chain than me and that have all these great ideas, right? Ideas around life insurance and tax savings and real estate and getting creative. These are things that I did not come up with. All I've ever done is mirror what other people have done. And I like historical precedents. So I focus on people that have been having these things for a century or more, right? So those are the patterns I like to mirror because to me, there's relative certainty in that. And so that's really what I try to focus on. Improving my sphere of influence by making sure I'm leveling up with those individuals. And inevitably, I tend to learn their skills. My mindset expands, and it just helps with the entire world of opportunity that individuals that are further down the road seem to be able to present to me.
It's good stuff, Sean. Really appreciate the time. Appreciate kind of what you've brought to us here today, which I think is really valuable for everybody that is a higher earner and wants to leverage their wealth, right? And be able to have that wealth begin to work for you and be positioned to take advantage of opportunities that'll come in the future. So appreciate it very much. And to everybody listening here today, my final request are these 3 simple words, and they are go think bigger. Sean, appreciate you helping us do that today.